So good afternoon, everyone. When Professor Singh invited me, first of all, sanity check, last row, can you hear me? Loud and clear? So when Professor Singh invited me, I was supposed to come earlier for another function when the CA had arrived. Unfortunately, I could not make it. I was a little, not scared, but I had some trepidation. What would I talk about in an institute which is so rigorous in the academics of economics, and banking is a subset of economics? So I can talk about what, as a banker, I do. Perhaps that is something which the students may not know. But nevertheless, it's an honor to be here, and thank you, Professor Singh, for inviting me. What I have done here is, and I'm aware of the time constraint because we are all keen to hear Professor Chaturvedi also, and just to add to the description given, Professor Chaturvedi is still on the board of the Reserve Bank of India. So therefore, I think that is something which was not spoken. And Dr. Singh, of course, is part of the Monetary Policy Committee. Such an honor for the institute. So I have divided my presentation into three parts. The first part is I do want to talk about State Bank of India. It's my responsibility, role also. But more importantly, because all of us know State Bank, and yet we don't know State Bank. At least even within the bank, before we did this project, and we had a massive outreach program since last 6 months, where we were talking about not only the bank's current standing and the future challenges, etc., but also the legacy. This is a 218-year-old bank. Now, 218 years is a large amount of time. So what is the bank has been doing all these years? So therefore, very briefly, I'll talk about that, the current state of State Bank of India, what role it plays in the nation's economy. And of course, post that, banking in general, Indian banking, and then what are the challenges before the banks, and how do we support India to reach 2047 Viksit Bharat objective. So that's the kind of flow of this presentation. I think there is a Q&A session, but possibly it will be after the presentation. And both me and Professor Chaturvedi will be available for questions. We'll welcome those. With that, let me start on this. This is a busy slide, and I'll just capture the history of the bank in a very short while. 1806, this bank was set up by British government officials. Remember, some of those who know a little bit of Indian history, this is the time of East India Company. The British government had not yet taken over, and therefore East India Company officials and European merchants together came together in 1806 to set up the Bank of Calcutta, which was the first constituent of our bank. And in this, their objective was to stabilize the interest rates and to provide credit to themselves. So first thing to remember is no Indian interest at all. It was entirely the interest of East India Company and the European merchants. All of them were outsiders. The other thing to remember here in terms of history and politics is that by 1806, the East India Company was the preeminent political power in India. In 1757, the Battle of Plassey, the East India Company under Robert Clive had already defeated the Nawab of Bengal, and then that is Siraj-ud-Dowlah, and then followed that very quickly at 1764, the Battle of Buxar, where the combined armies of Shuja-ud-Dowlah, Nawab of Awadh, the Mughal Emperor Shah Alam II, and again Mir Qasim, the next Nawab of Bengal, had been defeated by East India Company again. So as a result, though Bengal, Bihar, and Orissa, the Diwani of these had been passed on to the East India Company, which means the right to collect revenue. And land revenue from agriculture was the major source of revenue in those days. So this had happened. And post that, in a series of battles, the East India Company defeated all the major powers who either settled with the East India Company or were defeated and lost. So for example, 1797 or 98, Tipu Sultan, who was a major enemy of the British, gets defeated and killed in the Battle of Mysore. Then Marathas, who were also a predominant power by that time, they were defeated in a series of battles where the British very conveniently divided the Marathas amongst each other. The final third battle, Anglo-Maratha War, happened in 1805, and by the Treaty of Bassein, ultimately the Marathas, remaining people, settled with the British East India Company. So by 1806, there is no political competition left. The Nizam had settled, and all the others, Mughals, were too weak. So everybody had settled. British East India Company is the main power, and now they decide to set up a bank, not before. They had also defeated the French, Dupleix, and all these people. All of them had been defeated. So they are the major powers, and now they want to expand banking and trade. fantastic, because economy develops only through banking and finance. So that's the thing to remember. This Bank of Calcutta started. This building on the left side still exists. It is close to our own main head office, and it's a heritage building, of course. So if you ever visit, do try to see that this is where the banking, modern banking in India started, Bank of Calcutta. And of course, shortly after this, in 1809, this got renamed as Bank of Bengal. And then there are two other banks which got set up, Bank of Calcutta, Bank of Madras, and Bank of Bombay. These three banks were also called presidency banks, because they were all located in Calcutta, Bombay, and Madras, which were also called presidency towns. Why? Because these are the places where the British East India Company had their major factories or warehouses for goods, because the major trade used to happen by sea, and all of these are major ports. So therefore, all of them, these were where the banks were established. These banks all continued in their own different ways, and in fact, the Lucknow branch of the Bank of, I don't remember whether it was Bank of Bombay or Bank of Calcutta, under which the Lucknow branch at that time fell, but that got set up somewhere around 1860 odd, 69. The Colombo branch, which is the oldest foreign bank branch anywhere in India, got set up in 1870 odd, and that building still stands. We are still located in that branch. So all of this was happening. The banking was getting spread. But in 1921, these three banks were all amalgamated and together to form the Imperial Bank of India. This is our immediate predecessor. And why was this important? Because it was thought that they needed a stronger bank. In fact, all these three banks were also responsible for the central bank's role partly. And when Imperial Bank got created, RBI was not existing at that point of time. RBI came through the Hilton Young Commission in 1934. In 1935, the RBI Act was passed and the RBI got set up. So in our sometimes informal conversations with RBI, we tell them we are senior to you as a regulator, because we used to do the central bank's role, be the banker to the banks and all of those, except for issuance of currency. Because the Mint of Government of India was always an independent function apart from the central bank. So therefore, these banks were amalgamated, and last year, our Mumbai main branch completed 100 years. And the Honorable Finance Minister came, and when she spoke to us, then she mentioned this fact of 1921. And she read out the operative portion of the proclamation which was made, which was to say that it is useless to expect the spread of banking in a civilized society unless there are bank branches to back it up. And the bank branches were not large in number. Now, the things she pointed out was that this was so derogatory a language for Indians. The British always had a very derogatory view of Indians in general. So therefore, the target given to that Imperial Bank was to open 500 branches in next 5 years. And after that, this continued, then the RBI came up, and when India got independent in 1947, State Bank of India was formed by an Act of Parliament in 1955. So it took about 8 years for the State Bank of India to be formed, and then at that point of time, the number of branches was 1,260. So imagine after this 120 years or whatever number of, more than 150 years, the number of branches is still below 1,500. And therefore, the State Bank of India Act, which is a separate special act, contains a line that the bank will open 500 more branches in the next 5 years. So this normally is never given like this, that the number of branches are stipulated in the act. But that was the logic, and the government, of course, thought that we should have a national bank. All these banks till now were private banks. There were a lot of private ownership and all. So they were private banks, and that's why ultimately we got nationalized on 1st of July, 1955. Interestingly, the Imperial Bank continued in a shell kind of status, because there were so many guarantees and the hundis and all issued by them which had to be honored in their own name. And then everybody forgot about it. So in 1990, somebody remembered, okay, Imperial Bank is still existing. Then it got finally closed. So that's a little bit of history, but let's come to something interesting. This is what the State Bank of India published in all newspapers of the country, not only English, but it also in vernacular. And I'll read this out. This is on 1st July 1, 1955, the State Bank of India came into existence, taking over the business of the Imperial Bank. It offers you all the services you require and expect. You will continue to benefit from the guidance of experienced officers, and your business will receive the same personal, completely confidential attention that has been given in the past. Not only have we inherited the sound banking traditions of a century and a half, but we have also inherited the public goodwill that has been so marked since 1806, when our first constituent bank was founded. And our policy, as always, will be guided by this ideal to further your interests and those of the entire nation now and in the years to come. And this was under the heading of security for generations to come. Now, this is a promise being made by State Bank of India to all Indians, all citizens of India, that we will always be guided by your interest and the interest of the entire nation. Such a massive promise which has been made. And how have we fulfilled this promise? This is something, a story which is not again well known. Remember, from 1955 to 1969, when the first nationalization wave took place, we are the only public sector bank. There is no other national bank. Every other bank, Bank of Baroda, Punjab National, all of them are private banks. So therefore, the spread of banking in India by opening branches, by banking farmers, small merchants, traders, all of this in this period was done by State Bank of India. More importantly, as you know, in the 1960s, which was such a difficult decade for India, starting with the China war, followed by the Pakistan war, the first Pakistan war, and then the Bangladesh war in 71, in between the Nathula in 1967. So 4 wars, or one mini war. And then we had series of famines in India. Earlier, the difference was that when famines used to happen in British India, a lot of people used to die. In fact, the last famine in British India was in 1943, which was the Bengal and Orissa famine. It is estimated 30 lakh people died. 30 lakh, can you imagine? I mean, this kind of thing, and the British simply did not care. There are various books where it is said that Churchill diverted the ships of wheat away from Australia just because they were more interested in the profits. So therefore, when India became independent, we as a national government did not allow people to die in famine. But our agriculture productivity was not good enough to be able to feed our own people. And therefore, in the 60s, India was importing a lot of food grain, some of which was given free as a grant by United States. And therefore, as it always happens, more powerful nations sometimes become very arrogant. One of the statements made by Lyndon Johnson, the president in the 1960s, was that India is a ship-to-mouth country. That means when our ship reaches with grain, with wheat, then only Indians are able to feed themselves. While this was correct in fact, but it was such a humiliating statement to be made. And therefore, the India decided that we must be able to feed our own people. And as a result, as we are aware, that India got together the scientific prowess of the Indian Agriculture Research Institute under Dr. M.S. Swaminathan. We also brought in Norman Borlaug from the Mexican Institute, and the Mexican small dwarf variety of wheat was brought in. And then the latest fertilizers, pesticides, all of this was used to create what is now known as the Green Revolution. Punjab and Haryana, this started. But what is not known is who was funding all these farmers for fertilizers and pesticides and crops. It was State Bank of India. There is no other nationalized bank. So the Green Revolution, while a lot of credit is given to all kinds of people, State Bank of India is a silent worker funding all this behind the scenes. So I think this is one part of our history which has to be known to people. Then we go forward. I'll just fast forward 15, 20 years. We come to, through the 80s, we are opening a lot of branches, we are hiring a lot of people. But in 1990 and 91, when the Iraq war happens and India is short of foreign exchange, all of us know that we had 6 weeks of foreign exchange left. And so you know, the foreign exchange is important to us because we import 85% of our oil, now 88%. So if we run out of foreign exchange, then we can't import oil. How do we run our buses and cars and scooters and all? And I've seen this happen in Colombo 3 years back. I was part of the government delegation which went there to negotiate a loan from the government of India, which we gave as State Bank of India. But they had run out of foreign exchange, and therefore only the school buses and ambulances were running. Every other person had to, the petrol was rationed, and after every 2 weeks, somebody would get some quota, 5 liters, 10 liters, and then they will be able to go anywhere. But we did not come to this situation because the government took so many steps. India opened up, we pledged our gold, we also took a loan from IMF. But one thing which is again not so well known is State Bank of India raised $2.5 billion for the government of India under the bonds which were raised to NRIs. These were called the Resurgent India bonds. And then very quickly thereafter, 97, again India is put under sanctions after Pokhran 2, because when the Vajpayee government exploded those nuclear bombs, 97, then US and Europe put sanctions on India. So while we were not short of foreign exchange at that time, it was thought that as a measure of confidence, let us raise some more foreign money, let us raise some more dollars, because we don't know how long these sanctions are going to continue. And therefore, State Bank of India was again asked, and we raised $4.5 billion called India Millennium Bonds. Now, both of these instances, the bank did not earn anything at all. It raised the money, it gave it to the government. And when the government repaid it, it just gave it back to the NRIs and those who had invested. But as a result of the second issuance, the United States got very unhappy with us, State Bank of India, because they thought we are helping India to bypass sanctions. And as a result, they instituted a special audit of our New York branch, which went on for almost a year, and at the end of which, they fined us $7.5 million. But more importantly, they said that you have to do all these rectifications. Much of that was very strict auditing and the latest concepts of money laundering, KYC, which had just started. It was not even followed by US banks. So for 5 years, we were prevented from launching any new product or service, and our business, in a sense, came to a standstill. And we took this hit for the nation, because we did not gain anything. These bonds and all were all done for India. So therefore, we took that hit. So that's how State Bank has always stood up for the nation. Going forward, I think in demonetization, all of us know it's a near-term event. It is State Bank of India, whose branches actually served. We were open 24/7 in many days, and trying to pay as much cash as possible to the people, because such a traumatic time. And even in COVID, all our branches stayed open every single time, despite the fact that the instructions from the management were that if there is a local emergency, you can take a local call. But all of them stayed open. And as a result, we lost 858 of our colleagues. So my point is, State Bank of India has one bank which has always stood up for the nation. And in the great Indian tradition, we don't talk about it. We don't say that this is what we had done. But we are telling our employees this now, that you should be proud of being a state banker, because you have been serving the nation for such a long time. This is the 70th year as a national bank. So with that history, let us move a little forward. This is where we are today, almost 23,000 branches, 64,000 ATMs, all of you withdraw from ATMs, 78,000 customer service points, again very, very important delivery points. Regional rural banks, 14. Now, of course, after merger of them, we will have 9. Then 17 domestic non-bank subsidiaries. In fact, this is one of our interview questions in the junior scales, how many subsidiaries we have, what each subsidiary does. And for a long time, till I became managing director, I also did not know what each subsidiary does, because there is a primary dealer which invests in the government securities on behalf of the RBI. Its function was not understood for a long time. We have the life insurance, the number one life insurance company after LIC, the number one asset management company or mutual fund in the country, the number 2 credit card issuance company in the country. We have the general insurance, which is right now number 9th, but growing much faster than the industry, and our mission is it should reach in the top 3. Because if you are a state bank entity, you have to be in the top 3. There is no other way. Then we have joint ventures, we have associates, and the largest associate we have is Yes Bank, where we still own 23%. Then, of course, lead bank districts. And lead bank district, again, very, very interesting story. This is the service area approach in 1975, under which the banks were asked to adopt one district each, so that they could lead the development of the government schemes in that district. And very conveniently, State Bank said, let each bank take what district they want to take, whatever remains we will take. And as a result of it, Andaman Nicobar, Chhattisgarh, Uttarakhand, higher reaches, the Ladakh, Leh, all of this is with us as lead bank. So therefore, many of the officers today ask me, sir, why is it that Haridwar and Dehradun are with the other banks, and Uttarkashi and Pauri Garhwal, which is so difficult to reach even now, are with us? And I say we always take where no one goes. So this old Star Trek line, I don't know how many of you have watched Star Trek, we go where no man has ever gone before. Something like that, we've always done that. And of course, a proxy to the economy, we are there in all segments, but a customer base of 51 crores, approaching 52 crores, and 520 million. This is something when I was in the US, in our conversations, sometimes, normally we are very quiet and all, but sometimes I will tell them, we have more customers than you have your population, which is 334 million. So we do know how to run banking at least. So with that, I think, let's go forward. Now, this is again a very interesting slide. Look at this. It took India 63 years to reach 1 trillion of GDP, which means that the entire 60s, 70s, 80s, India was growing very, very slowly. In fact, the growth rate, and I'm here in an economist session, I think India was growing at 0.5%, 1%, 2%, so slow that this rate of growth came to be called the Hindu rate of growth, because it was growing so slowly. And therefore, State Bank of India also was growing, but obviously it is a subset of economy. So 45 years to 3 lakh crores. But you see the rate of growth after that, 7 years, next 7 years to reach 2 trillion, which means doubling in 1/9 of the time. And parallelly, State Bank of India, which had reached 3 lakh crores in 45 years, took 9 years to reach 10 lakh, which means 3 times. And similarly, the next 1 trillion for India came in 3 years, and for State Bank of India, 3 times in 8 years, less than the time. And now State Bank of India's balance sheet is excess of 60 lakh crores, it's approaching 70. And India, of course, is around 4 trillion, plus 4 trillion, and we'll hopefully reach 7 trillion. So therefore, State Bank of India has reflected India's growth, and in general, the anecdotal thing is that the GDP growth, whatever the GDP growth is, the loan growth of a bank or banking system is generally 4 to 5 percentage points more, or sometimes double the rate of GDP growth, which is borne out by this slide here, and we have large shares in most segments of the economy. In fact, the most interesting thing is MSME and agriculture, which was our reason to be created, our share has fallen because the other banks have also done well, and though we have done very, very well in the recent past, we are yet to catch up to our 20% market share. We are 44th in the top 1,000 banks as per banker. This is by asset size. We are in 29 countries. We have a $64 billion loan book. Our balance sheet is bigger than GDP of 174 countries. There are 196 countries in the world. 52 crore customers. There are various trophies we get. And this is the various things. Digital banking, 25% of debit card spends, 29% of ATMs we hold, 24% of mobile transactions, 26% of UPI. Then we have the social security. So the other thing is financial inclusion, which State Bank of India has done so much in PM Jan Dhan accounts. Though our market share in deposits is 23%, we have a 35% share. In the PM Suraksha Bima Yojana, which is a personal accident insurance, our share is 41%. In the Jeevan Jyoti Bima Yojana, which is a life insurance cover up to 2 lakhs, our share is 48%. Atal Pension Yojana, 32%. So all of these schemes, which are essentially government schemes for financial inclusion, our share is much, much more than our normal market share. So our contribution to financial inclusion is well established. And of course, there are other things like Mudra Yojana and all. I'll not go into all details. These are all available on our website as well. Agriculture again, now our share has gone up to 15%. SHG, the self-help group, again, we have a 29% share, more than our share in loans, which is about 20%. Retail advances, we have a 27% share in home loans. Now, interesting thing here is, despite being a very old bank, till 1980s, we were not doing much of retail banking at all. In fact, none of the banks in India were doing retail banking. And all of us think, I mean, our generation thinks that our parents saved first and then bought a house or a car or whatever, scooter, etc., etc. The reality is that the retail loans were not available. Except for the departmental loans, there were no loans available. So as a result, what could you do? You had to save and then invest. And as a result, everybody ended up getting a house of their own towards the fag end of their career. Maybe when they are retiring 2-3 years away, then that is the time they were able to save as much and maybe get the departmental loan and ultimately build a house. Now today, after 90s, when the private sector banks came in, they started the retail banking revolution. And therefore, after the private banks started this, today, of course, people get a housing loan even as soon as they enter into a job market. Earlier, the better, and they're able to enjoy a house from the very beginning, a car from the very beginning, the retail revolution. So State Bank of India actually did not start retail till late 90s. Because we were a little bit of a laggard, we were focused on industry, focused on MSME, corporate advances, which we still do well. Then we realized that this is a big thing we're missing. And for that, first we had to computerize all our branches because they were all manual till about 2000. And after that, we started this computerization, linkage of all the branches, core banking. Parallelly, we started retail banking, we started BPR. So within a period of 5 years or 7 years, we computerized everything, we started retail banking, and so much so that today we are the largest home loan provider, 27% share. We are the largest car loan provider. We are the largest, all segments if you look at in retail, we are the largest. Simply because when the State Bank decides to deploy its strength and focus on something, we are always able to do it. And this is true for India as well. Whatever India decides to do, it is ultimately able to accomplish. अगर आपको क्रिकेट में नंबर 1 बनना है तो आप बन जाते हो. So that's something like this. State Bank also follows that. And therefore, in all of these areas, we have done well. Corporate, of course, especially infrastructure, which Professor Singh mentioned, we have been a traditional provider of infrastructure. And today, again, We are the largest provider of infrastructure loans. The book is 4 lakh crores. This is the current book. We have provided loans and which have been repaid. There are many more. In fact, no project in India starts which needs a bank loan unless State Bank underwrites it and appraises it. Every other bank joins only after we have sanctioned it. So that's the kind of strength and the ability and we have built into our project finance book. And there are just 82 people who are doing this in the bank, which is a separate unit. And of course, on ESG, again, we are an outlier in terms of the kind of work we have done, and I'll talk about it more. So this now we come to India. All of this, most of you know that how the economy has evolved. The 2014, the US economy was 22% of the global economy, 80 trillion roughly. China was 13%. Now, if you look at today, US is 26. It has moved up. China has also moved up, but India, which was 2.6, has also moved to 3.4. And if we go to Viksit Bharat, the estimate is about 230 trillion of global economy, and the Indian economy, and we have calculations to show, about 30 to 35 trillion. That will be the estimate of GDP which India will have. And therefore, if we have that, the share of Indian economy to the global economy will be 13%, up from about 3.4 now. And again, we have shown the numbers, the growth rates, etc., which are expected for us to reach there, a CAGR of 8.9 from 2014. So 2014 to 2024, we have achieved this. But then going forward, we have to continue to achieve this. With that, let's move a little forward. This is what the Indian 5 trillion journey of 2027, how we have achieved it in different years. Then, of course, this is the, as I mentioned, 30 to 35 trillion economy by 2047. And then largely the services and industry will be the major drivers. The agriculture, while it will go up, but the share will keep reducing. And therefore, we need a lot of globally competitive firms. That's a given. Then, of course, this we have discussed, the per capita income, which is around $2,800 now, will expected to go up to $13,000 because that's at constant prices. That's the level which today it is said that a country reaches a developed state. And of course, we have these numbers of per capita nominal GDP. So I'll not go into detail, all of you know. Now come to banking. So this is the snapshot of where the bank's position in India today is. The branches, number of banks in India came down from about 12,000 odd to 9,500 today. This has been led by a lot of consolidation, not only in the public sector space from 27 to 12, but in the regional rural banks from 56 to 43, and now effect from May or September this year, it will become 27 because now the one state, one RRB has been implemented. The non-bank financial companies, which were about 12,000 odd, have reduced significantly. A lot of consolidation has happened. So therefore, as a result of this, if you look at the total branches, which have gone up from 1,24,000 or 23,000 to 1,67,000, the branch per lakh population, which is a metric to see in terms of service, whether branches are being serviced, we have gone up from 9.6 to 12.3, but compare it to US, which is 26.6 per lakh of population. And China is interestingly 8.8, which is lower than us. So which also tells us that China, which has an almost similar population to ours, has a lesser intensity of bank branches. Now this is counterintuitive. How is this the case? But the fact is that the Chinese have really gone digital in a very big way. And that's a great learning for us as well. And therefore, as we move towards digital, we have to see how many more branches do we need. But our sense is that we will continue to need a lot of bank branches simply because that India will always be multiple layers of people and their evolution as a customer. There will be people who would need hand-holding, even at a much later stage. There will be people who need advisories. So I think India's model always has been a different model from whatever else the world has been doing. So hybrid model always works best for us. In terms of ATMs, we are at 15.5 lakh per lakh, which is like US is 133 and China is 81. So I think there a lot of catch-up needs to happen. Of course, the more and more we go to digital payments, some part of this may not be needed. But that's where it is today. And of course, digital economy, we are 11.7%, the US is 10%. So our digital payment, of course, is fantastic. And we have done better than the US in this area, and even better than China. So that's a good thing. And it's, again, an achievement of the last about 10 years. And this is about the reforms which have been done since 2014. I will not go into everything, but look at this list. This is a representative list. So the IBC, as you know about the resolution which is Bankruptcy Act, which was brought in. The consolidation of public sector banks, 27 reduced to 12, so that each bank becomes large enough and they are able to take larger exposures, better handle risk. The international financial services at the gift city, again, they're offering a lot of products and a tax holiday as well. The NBFC and the collaboration of banks with NBFCs and startups. So again, with the NBFCs, this is the non-bank financial companies. The important thing is that NBFCs can reach the last mile at a cost which is not possible for the banks to do. And they can also, they are far more agile than banks, which have much more structured systems and processes. So therefore, NBFCs are a very important part of the overall economy. And they are the ones who will drive the more formalization of the economy. Because all those people who go to money lenders, first they will go to an NBFC or an MFI, which is a microfinance institution. And then as they scale up and their credit history becomes better, that is the time they shift to banks. And we have seen this happening. So therefore, collaboration between banks and NBFCs and MFIs is very important. Today that is happening through co-lending, whereby the NBFCs originate loans, and then the banks buy the portfolio. And similarly, securitization also, which is also happening. So there are different ways in which banks are taking the loans from NBFCs for priority sector also. But banks also lend to NBFCs so that they can on-lend further. So very, very close collaboration between the banks and NBFCs. In fact, the bank lending to NBFCs is almost at 12-13 lakh crores, is almost 30% of the NBFC's overall source of finance. Very, very important source of finance for them. We also have the new banks, the digital banks, which are coming up, but still yet to scale up or yet to show us sustained performance. Cash flow based lending, again, very important because of the availability of GST data online and the availability of KYC online. The result of all this, completely digital loans are possible. In fact, we have launched a loan product for MSMEs in which we are able to sanction in 1 hour, loan up to 5 crores, 1 hour, and this has a backup of a CGTSME cover, and also the GST data has to be there, Udyam registration also has to be there, and the only requirement here is somebody will visit the customer's place just to make sure that there is a shop or a factory in existence. Other than that, it's very fast. And of course, if you have an account with us, then we are able to give you a personal loan again in 30 minutes. It's a pre-approved loan. So with all these digital loans happening, I think the cash flow based lending is substituting gradually the so-called security based lending or collateral based lending, at least in the lower thresholds through the issuance of the CGTSME guarantee cover. So this is again a good development because for MSMEs, security was always a challenge. Then of course the central bank digital currency, CBDC, it has been launched. The only challenge to that, in my view, is that we already have a successful UPI. So with a successful UPI, most people don't see a good use case for CBDC. So the only use case would have been, in my view, had the platform, technical platform been different. Initially, the idea was to have a different technical platform. But ultimately, because of the challenges which were faced, now the tech platform for both UPI and CBDC is the same. So today, the single biggest challenge, in my view, in this entire tech space, and UPI is a fantastic example of digital, is the fact that it is a single point of failure. Something happens to NPCI or UPI, the whole country's digital payment shuts down. That's not okay. While still NEFT and RTGS will remain, but I think we need multiple platforms to be able to serve the country, and we have these political challenges, the security challenges, hacking and all are very, very organized today. So we need to have backups even to UPI, and today that doesn't exist. Of course, then we have other things like the NARCL for the bad bank, which has been created. It has taken over almost lakh crore of bad debt, and it's resolving this. NAFID has been set up for infra. So a whole lot of things are being done. There are 3 other things which are listed on the right side in red. I don't know why challenges are always associated with red for some reason. But one is credit to informal micro enterprises. Now, interesting thing is that if you look at the MSME studies, there is a credit gap which is identified of close to 20 lakh crores. This number has stayed consistent, about 20 now, it may have gone up a little. What is the challenge in lending to MSMEs? The biggest challenge in my view is that MSME has a space, and there are about 5 crore units in MSMEs. But in 5 crore units, 90% are micro, which means their requirement and their investment, etc., is less than 10 lakhs. So they are very small units. They are your street shops where one person is operating, one person is managing the whole thing. So clearly these have multiple challenges. One is a lack of capital, which is how do they invest themselves. Second is a lack of data, and they may or may not be having a GST registration simply because 1 crore is the threshold for GST. So therefore, they may not have a GST registration. So how do you get that data of sales and various other numbers? And third, of course, is they may not have a collateral or a security which they can offer to banks. And lastly, they have a single man operation. Something happens to the main person, the whole enterprise shuts down. And they're always under pressure from the larger suppliers or buyers whom they serve. So therefore, with MSME, this is a big challenge. And how do we provide this credit to these informal enterprises? This can only be done through MFIs and NBFCs or digital lending. And there is also a challenge of high transaction cost and high recovery cost. It's easy to give out loan, but how do you recover from small amounts of recovery? So therefore, the idea here is how do we bring them into the fold? Because otherwise, on the other side, if they're borrowing from informal sources or money lenders, the rate is 2% a day for many of them, which is 60% a year. Compare that to a traditional bank loan of 10% or 11%. Even private banks charge not more than 13-14%. So therefore, it is very important for us to bring all these units into the mainstream, because without which they will never be able to scale up or survive. 60% nobody can pay and survive. And then, of course, net zero climate goals. This 10 trillion number, again, is a very varied number from 8 to 10 trillion. But 10 trillion is just for converting the current sources of fossil fuels to a renewable source, etc. It does not include, this is a transition cost. It does not include the adaptation expenses which are required for all these natural disasters, etc., which are led by climate, which are coming. So huge challenge. The current funding for this is not even a trillion. It is less, some about 50 odd billion. So huge challenge. How do we fund this? And of course, the cost of everything is always a concern, loans and all. Now, if you look at this, the Indian banks are today in a very good position. The NPAs, the non-performing assets, at a historical low, 14-year low, 2.4%, and now they are about 2.4% now, and they had reached a peak of 11.2% in 2018. So therefore, very, very good position. And the capital adequacy at 16% is also very good. So therefore, banks are in a fantastic position to be able to lend to the economy. So this is a good situation currently. And then if you go forward, this is the way we have calculated till 2047. What is the requirement of the bank loans to reach up to? Today, the bank loans is 182 lakh crores. And it is estimated this needs to go up 10 times to 1847 lakh crores. Or if you calculate in $1 trillion, $16 trillion. Same with deposits, with an 80% CD ratio, 20 lakh trillion deposits, and therefore 2300 lakh crores. So huge numbers for doing Viksit Bharat, 10 trillion, we have to go up 10 trillion. And then of course, this is the issues. So this is the last part of my session, my presentation. I'll just be brief on this. What are the challenges we face today, which we have to solve? One is the increasing digital frauds. Now, just to give you some idea here, this is 23-24, 28 lakh cases were reported. This is I4C data, 177 crores of loss. And for the 9 months or 10 months this year, 24 lakh cases, but look at the amount, 4,200 crores. So every single month, the digital fraud is going up all the time. And we have a big challenge because this needs a whole of system approach. No bank alone can do this because these people are opening mule accounts in different states. The person is defrauded, they get a phishing call perhaps in one state. The transaction happens in another state. The money is withdrawn in 2 different states. So like all states are involved, and this is still a state subject. So we probably need a digital police for this who can have an all India approach. Otherwise, it's very hard to get recovery at all. Attrition is more applicable to private banks. It's 25% for us. In the public sector, it's just about 3-4%. Deposit mobilization for the last 14 quarters was lagging the loan growth, not only percentage terms, but also the absolute terms. So the challenge was 100 rupees you get as a deposit. You can't lend everything. As per the last CRR and SLR, you could only lend 78.5 out of that. Now, if already the loan growth is higher, which means your loan growth is 120 and you are getting a deposit of 100, then it becomes a much more challenge. How do you continue to lend? And many banks had reached a CD ratio of more than 100%. which means it is just not sustainable. So therefore, this, of course, it has now tempered down, unfortunately, because the growth is starting to come down. But this is one big challenge. And ultimately, in the developed countries, what happens is that banks also borrow. But if banks borrow and lend, then the margins of the banks are very small. So that's a big challenge before the banks. Liquidity, again, a lot of thanks to the MPC and thanks to the RBI, this has kind of sorted out now. Cybersecurity, we have talked about, it's a massive challenge. One of the challenges of cybersecurity is that if a virus is to get into a bank, today the bank systems replicate in the disaster recovery sites at an interval of 2 to 4 minutes, which means if a virus gets into the main server, it will get into the backup server also. And how do you then come back to operations? So this resiliency of operations in the cyberspace is another big challenge before the banks. And we are examining various ways, how do we do this? Unsecured retail credit, again, delinquency risk is high. RBI was also concerned, so risk weights were increased. All of this was done. But my point is that unsecured retail credit, and if you include gold loans, which is today again the focus of RBI because the growth is very high, my point is lot of these gold loans are actually business loans. They are not necessarily consumption loans, because that's the only asset a rural householder or a person who's not very well off will have, and they will not get a loan from the bank in the normal course. So for them, the gold loan is the easiest way to get a quick loan. And if the NBFC or the bank is unable to give that because of whatever regulations, then I think we are sending them back to the money lender, which is not good for anybody. So I think this provision of unsecured loan and the gold loan, etc., has to be seen in the context of financial inclusion also. Third-party outsourcing risk, I think they are going up all the time because the entire IT is outsourced today. The entire, much of the servicing also is getting outsourced, and we have to be on top of this. Climate, we have talked about, but the more important thing is South Asia as a whole is very exposed to climate risk. We see all this flooding, etc., happening all around us. And as a bank, our collaterals, our properties, housing loans are all exposed. And what are we doing about this? Today, actually, we are taking the same insurance, whether it is Kerala exposed to floods, or it is Rajasthan, which has no floods, the same insurance is being taken. Actually, the insurance should vary state to state depending on what the risk is. It's not being done. And not only that, beyond insurance, we have to look at building codes and all of that as part of the climate risk, which is currently not done. But at State Bank, we have started doing this. And of course, financial inclusion lending I've talked about. This gold thing is a massive example. India imports almost 560 tons of gold last year. And on top of that, about central bank also holds about 70 odd tons. So if you look at the current gold loan portfolio, it is about 15% of the overall stock of gold held in India. Now consider if we allow this to be, the rest of it to be monetized, which is household gold largely, how much loans can be generated, how much support in terms of lending can be given to the households. That is a missed opportunity as of now. So I think I'll stop here because we always have to stop at some point. There are so many things I want to talk about, but I think it's time for us to listen to Professor Chaturvedi, and then we will take some questions. Thank you very much.
Thank you so much, sir, for such a knowledgeable session. Now, I would like to invite Professor Sachin Chaturvedi to kindly come up on stage and deliver his chair address.
So this is for next, this is for previous. I can do from here. Yes, sir. This one. Yes. Thank you. At the outset, I must thank Professor Ram Singh for giving this opportunity of reconnecting with Mr. Tewari after a long gap. And thank Mr. Tewari for a very exhaustive exhibition in terms of how we look at India's banking in 2047. And how we look at the issues which are of greater significance in terms of how Indian economy should position itself in terms of going forward, and what are the ways we can do the course correction. I would give myself 10 minutes and very quickly run through the slides that I have thought of. There are a couple of issues which I would very much like to bring to your attention, particularly in terms of India's own approach to Vision 2047. Some of us were involved in the exercise, have evolved the document, and I would very much recommend to all the students who are interested in seeing the scenario analysis that has been done to read this vision document and see the kind of scenarios that have been drawn, what kind of push we are looking at, and what kind of issues that are coming in. The important part of it is not that banking or finance or a specific any other sector that would come up in this, but a large sum of things. And this is where the current policy making is going in. What you are seeing in Trump's action, what you are seeing in what is happening in the US and subsequently in many other continents is largely this idea of converging trade, investment, technology, and finance. All four: trade, investment, technology, and finance. They all are converging. And this convergence is giving you new set of challenges, but policy options and opportunities. So as an economist, we cannot remain economist alone. How do we bring in skills that are needed to bring in convergence? Of course, without compromising skill as an economist. So that part has to be retained. And a wonderful example is Professor Ram Singh himself, who has combined his skills in as being economist with that of the legal profession, the legal dimensions of rule making. Professor Suren, who has combined sustainability as part of being an economist. And this, I think, is going to be even more complicated for us to see how we analyze. And that is also going to be true for banks. And let me quickly run through a couple of slides. So here I wanted to say that what Mr. Tewari said of $30 trillion, broad dimension of 13%, perfectly fine. That's what largely the projections are. We are finding it around four broad pillars, and then trying to see the strategies in terms of trade expansion, technology transfer, the security collaborations, the geopolitical influence, the climate and environmental concerns that are there. Also trying to see how the legal foundation would come up. And that probably would be extremely important in terms of how these dimensions are adequately addressed, and in what way we bring in issues which are there for Viksit Bharat. But the context of financing and banking, I think, is something which Mr. Tewari has very well articulated. In terms of vulnerability and in terms of risks, there are two dimensions of it. One, risks that are getting accumulated over a period of time. So how do you address those risks? And then there are risks which are largely coming in because of interconnections. Interconnections because many of these financial institutions are combining their roles. And as he was explaining, NBFCs, banks, their exposures, and their institutional societal connects, they make things far more vulnerable, far more risky. And as a result, you end up in a situation where complex and unpredictable choices come up before you. They also try to bring in issues where large dimensions of these choices are dependent on the nature of technology. But what you are finding in technology is this huge challenge of monopoly. Few companies monopolizing on almost all softwares, almost all spaces where you go for cloud access, and the cloud providers, they are also in terms of the software providers. So the full chain is dependent in terms of how we are going to go forward. And this is something which Nandan Nilekani and Augustine Carsten, who is with the BIS, the Bank for International Settlement, they came out with a very interesting paper and a very interesting term, Finternet, where finance and international dimensions are converged. And I would encourage you to see this BIS working paper, which has captured details in terms of how we look at Finternet and what are the ways Finternet can really be taken forward for our analysis, not only for regulatory purposes, for which we in RBI look at it, but also for analysis in terms of identifying. Largely, people are saying that in next 25 years, by the time we reach 2047, the banking structure would remain what it is now, a two-tier structure. One led by a central bank, which is playing the regulatory role, and second of the commercial entities who would be engaged in whatever they are doing. The tokenization that would happen, and tokenization that has its own benefits would continue to evolve as a part of the second tier. But you also find that there would be unified ledgers, the artificial intelligence and technology, large collaborations, and also multiple dimensions that are going to come in. Here, issues related to geopolitics would also come up. The dimensions of geoeconomics would come up, like for instance, Bridge, which is the last point on this slide. It's an initiative that was launched by China on name of BRICS, but was largely to connect Chinese entities across. The whole suspension of SWIFT by US, which is a global public good, and that led to launch of similar platforms and weaponization of financial instruments, is going to be another major challenge for us. And that's where we find what Mr. Tewari explained in terms of fintech and banking connect, and that part I think would be extremely interesting. But this is a trend that is already evolving in many parts of the world. You are seeing that more of fintech companies are entering in the space that was hitherto occupied by banks. So in Brazil and many other countries, you find that fintechs are becoming banks and banks are becoming fintech. So this two-way process is evolving and is going forward in a major way. And if you analyze intellectual property protection, IPRs of fintech, you also find this. Today I don't have time. I'm already 7 minutes. So I think it would be worth dealing at some point, Professor Ramsingh, in terms of how fintech specific knowledge is occupied by specific entities who are going to then determine the dimensions of engagement. And in this analysis, you find that a large number of Chinese firms that have entered in the fintech patent space. Largely, if you see, central banks are missing from the scene. They are vendor dependent. And this is something that at least in RBI we are trying to do in terms of how do we get our dependence reduced on vendors in IT. We are also trying to see how Bank of America or IBM, both key holders of these patents, and then of course China. So these three entities are challenging us. How banking would look like in next 25 years, I think for any meaningful analysis, we should also see the evolution that Mr. Tewari explained to us, because foundation comes from there. But also what would happen in the rural areas, what would happen in urban areas, and what would happen in the technology space. These three areas we should see. If Professor Dholakia is here, Ravindra Dholakia from IIM Ahmedabad, he would immediately say, we haven't properly defined rural and urban areas. Their territories keep on changing. Even if I accept his objection, we should see carefully how the regional rural banks would emerge. What are the ways cooperative banks would emerge? What are the ways, as Mr. Tewari said, private sector banks would emerge? Are we going to reduce brick and mortar branches and going to go more digital? What would exactly happen, and how that technology would be controlled? We are also seeing in terms of the rural-urban divide that is there, both in terms of the determinants that are there for lending and credit, and also in terms of new sectors. And here, some of you, those who are looking for master's dissertation, should look into what happened with credit creation when a specific sector is listed for priority lending. So with finance minister, we were pleading for bringing shipbuilding into this. Tourism has also come along with this in the last budget speech of the finance minister. And if you see what happened in 2019 when we added renewable energy, 265% increase in the credit creation for that. And since 1950s, only 6,000 crores for shipbuilding. Shipbuilding is a hugely important area for us. Earlier, 54% of India's GDP was coming from trade. Now it is 44%. So if you look at things which are extremely dependent on economy's performance, but you don't have the wherewithals to go forward. So that's where this year's announcement is extremely important. Then there are spillover effects of financial institutions. What N.K. Singh, Larry Summers' report said for MDBs of bigger, bolder and better. We need to see how our own banks are going to go forward. Government's efforts in terms of converging, merging some of our banks and their operations has given some strength, but we need to see how that can be done better, which is more outside India. And we saw the numbers that Mr. Tewari had to share with us. We also got a study done recently in terms of what foreign banks are doing to promote their exports in India. And this is something very revealing. We find that almost 12 foreign banks in India are promoting their exports to India. And there means the country to which those banks belong to. And we are finding that more than 30% of India's imports are financed by those banks there. So the future banking operations would become even more murkier as geopolitics combines trade and other instruments of our understanding. And that's where we need to identify the channels which would be allowing the central bank to monitor. Because quite a few of these loans are out of the purview of the RBI, because they do not come in as official loans by the importers. So the entry books are not clear in terms of how that money is being settled. And this is something that is increasing now. Also, to quickly close, in terms of the challenges that are coming in is in terms of new technologies that are there. What kind of issues with the application programming interfaces that would come in, how this increased digitalization would bring in more personalized services, but at the same time also risks that Mr. Tewari mentioned from climate-related dimensions of it. These challenges are going to make technological adoption far more challenging. And that's where India's own challenges in terms of why we need more innovation to come in. And IDRBT, which is the RBI's own research institute on technology, is trying to do things which can help us create these global public goods. Digital public infrastructure is one big contribution by India's G20 presidency. I had spoken about this here in this very hall, but we need to focus and work that out in terms of how those technological connects may come in. RBI's own focus I would avoid at this point, but certainly I think 2 points that I want to mention and then would close is in terms of the fintech market that is there. So this convergence that Mr. Tewari talked about, and also in terms of the skill gaps. So people from economics background, if they combine their training in economics with skills in IT, a large challenge for India would be addressed. Multiple job opportunities are there for students of economics background to pursue in regulatory architecture, to pursue in the future banking financial architecture. So if I have to advise any student in economics, I would very much like them to develop alternative IT skills to be part of the future banking architecture. And number of jobs would be there, and somebody coming out from D school, it would be far more advantageous because the foundation of economics is very strong. And this opportunity would be huge in terms of how we are going to bring in AI and blockchain technologies. combining with the way financial architecture would emerge. It would also be in terms of new efforts that our own IFTAS and others have launched in terms of creating our own clouds, and we are getting into the spaces that are required. Also, the part of financial inclusion in terms of measurement and the new indices that have come up, they are largely bringing in the solutions that are needed. Just to close, the last point that I want to mention is in terms of bringing in effective governance. So in next 25 years, what are the challenges for this effective governance? What are the ways we would manage the risks? And as I said, trade, investment, technology, finance, all four are combining. So the banking architecture would have less considerations within the domestic arena of India than the external connect. Economy is going to expand more and more international after tariff liberalization, trade would be opened, investment would be opened. So far more challenges to protect us from these intrusions that would happen with technology and also with the physical presence of the actors. Thank you.
Thank you so much, sir, for such a delightful session. Now I request Mr. Ashwini K. Tewari and Professor Sachin Chaturvedi to kindly come to the stage for the Q&A session.
We witnessed two fascinating talks, and it struck me that these two talks together covered very wide-ranging issues, from history of SBI to the history of banking in India, to the issues and new challenges that are emerging, and strengths of Indian banking sector and challenges that lie ahead of us. And in Professor Chaturvedi's talk, we had international dimensions covered, and also he made it amply clear that part of his talk and his perspective also comes as a regulator, where Mr. Tewari spoke like a banker, true banker, and Professor Chaturvedi took care that there is a regulator also around to. Yes. It's a very enriching experience. With this, let's open the house to Q&A session. Professor Chaturvedi, with your permission. Questions? Very good. Okay, so we will start from this block. There are two questions in this block, and then we will take a round. So we will take a couple of questions, and then our two speakers will respond. Yes, we can start from here.
It was a great session. Both of the presentation was great. So actually my question is related to Professor Chaturvedi touched the point a bit, is the recent global uncertainty because of the US, some new policies introduction by the Trump government. So how this banking sector is going to evolve, especially when countries like India and other big countries are linked together globally financially. So the biggest challenges that we are going to face because of this uncertainty, how Indian banks can tackle this particular point.
Very good. Yes. Can there be mic? Let's take mic too.
So my question is addressed to Mr. Tewari. Sir, you mentioned this point that MSMEs are facing a huge credit gap, in particular the micro enterprises. Sir, can you elaborate on how digital banking can actually solve this problem? Because latest NSSO data suggests that only about 21 to 22% of informal sector enterprises are actually digitalized.
Let's take one more question. There was a question this side in this block back there. Yes, here.
Good evening, sir. My question to Tewari, sir. So my question is from credit. So my question is from credit issue that if we see in the rural economy, informal, there is a lack in demand for institutional credit and the supply of institutional credit. Because of the money lenders have better information and they accept collateral in any form, but the institutional credit market does not accept collateral in any form. So how can you, how the SBI can tackle these problems?
Thank you. So I'll answer the questions in the reverse order. To your question on agriculture and how can State Bank, or for that matter, banking system support agriculture. So banking system is already supporting agriculture in a big way. In fact, the Government of India every year has been increasing the target for agriculture finance significantly. Right now, I think it's about 27 lakh crores, the overall banking system credit, and this is on top of 22 which was achieved last year. So last 4-5 years, we have been achieving. The challenge is that you talked about collateral. So what is happening is that the Kisan credit card, which is the major working capital finance for crop loans, does not require a collateral. It used to be about 2 lakhs. Now I think the limit has been taken to 3 lakhs or 4 lakhs. So that lower segment of small farmers don't need to provide any collateral. So that is one. Second is that this structure of agriculture finance is evolving. Now today there are multiple ways in which it is being delivered, because we have to remember agriculture is, or the rural economy is beyond agriculture also. So there are support services for agriculture, there are also other businesses. So if you look at the rural economy overall, then the concepts of farmer producer organization, which are large aggregations of farmers which have a corporate existence, then we also have these cold storage chains, for example, value additions. All of these formats are getting more popular and they need large amount of credit which only banks can give. So that is happening. Then the third pillar is the self-help groups. Actually, that is also turning out to be a very powerful tool, because earlier these were not guided properly and there were a lot of defaults. Now with the National Rural Livelihood Mission, NRLM, under their guidance, the recovery rates have gone up very, very good. So, and therefore, as a result, SHGs in many states, and I would mention Odisha, mention a couple of northeastern states, I think Rajasthan also to some extent, these are doing very well in this space. So agriculture as a system overall is evolving very much, and banks are a very central part of this. Sorry, I'll just quickly take up the MSME case. MSME, yes, so micro lending, as I explained, those enterprises do not have a regular data, and digital lending surely is helping. The challenge with digital lending only is that needs a lot of data of the enterprise. Now that data for micro is not existing because most of them actually are not registered on GST. The threshold for GST is 1 crore of turnover. Most of them have a lower threshold. So what is happening is, if they are part of any supply chain, which means they are buying from a large entity or they are supplying to a large entity, then they get registered to GST regardless. And if that happens, then clearly this credit flow starts to happen. In fact, interestingly, yesterday on my flight in, I was sitting next to a startup founder, and she was explaining to me how they have tackled the supply chain issues, where the wholesalers are giving credit to retailers for about 40-45 days at no interest. So how does a fintech come in between? So they are solving this by digital, by showing the insights. They put everybody on Tally, which is a software for accounting. So all those micro enterprises retailers got onto Tally, and then that data started flowing in. So there are various use cases. This will ultimately happen, but at this point of time, getting data from them is the biggest challenge which we face.
There are 3 ways we can see how our system would be affected by this uncertainty. First and foremost is this whole contempt for global norms, which are there for governance purposes. So the fact that Fed is not doing what is required to be done, such explicit statements on the norms for rate of interest or even for Basel norms. So both have been questioned by the president and his team. So one set of imperatives which we may have would be in terms of global governance of the financial architecture. That's one part of it. The second, extrapolate that to other entities who are not falling in line. So the other countries, you apply similar rules and regulations that you are adopting domestically to other countries. So we would become vulnerable. Third, which would be what Mr. Tewari in his lecture mentioned, and if you recall, he referred to the way India suo motu issued bonds and tried to raise money from the market. And not that we were not ready to repay, we were ready to repay for that money. But the fact that US monopoly over, and if you see what happened in early part of this century and what is happening now, there is very little difference. And as a result, what you are seeing now is a possibility of a very new counter architecture to come in, which is led by China. So you find that multiple other avenues are coming in. When SWIFT was suspended and access was not provided to China, they launched their own framework with 38 countries to do the digital transactions. Everybody kept on denying that RMB is expanding, it is 1%, 0.5%. Suddenly we discovered it is 10.8%. And they have identified through Ambridge 17 countries, just 3 weeks back, 17 countries with which China has established not only the digital payment settlement system, but has also given them the RMB's digital currency. So RMB CBDC, which was confined to domestic pilots, now is being commercialized by China with these 18 countries. And incidentally, all 18 are BRI signatories. So you find what Geeta wrote in her paper from IMF working paper last year. In the column that Business Standard has republished day before yesterday from Martin Wolf about the verticalization of trade. And this is where investment, and the point that I was making, that would come in. Because uncertainty, as you asked, is at these 3 levels that I explained. So that's where verticalization of trade would further supplement to that. And that's where concentration would happen of countries that are loyal to US or countries that are loyal to China. India and many other countries would have a huge challenge to do the balancing act. And some of us, particularly the not BRICS but IPSA, India, Brazil, South Africa, IPSA countries would have to do this delicate balancing that is required, plus Indonesia and a couple of others would join in. In RIS, we are very closely studying what countries, what trade behavior, what financial heft, and what is the composition of their reserve currencies that are there. You might have seen RBI has started multiplying gold accumulation, and we are trying to get into that direction. But this is where our direction would be.
Thank you. So in the interest of time, we have scope for okay, these are too many questions. I must ask the chair. There are 4 questions. Can we take 1 or 2?
All 4, but answer over the
Okay, please keep your questions pointed. Yes. We start from Sanjay. Do you have mic with you? Okay, so since mic is here, we start from here. Yes.
Good afternoon to all the dignitaries. In such a short span of time, I don't remember how this much of the knowledge I could gain ever. So great event. So my question is very general, very subjective in nature. Given that the monetary authority does play a role in terms of setting the interest rate, but the mood is basically set by the banking system, the commercial banking system. So what role in the coming times, given the warnings from the Trump also, do we expect that the monetary policy transmission mechanism is going to play? And secondly, the business mood of the country will have to be set right for the Make India agenda to be strengthened. So, and one last thing, is it the time to move back to multiple indicator approach rather than inflation targeting? So quite a broad perspective, but in general.
Yes,
My question is, like, whenever bank or any financial institution lend gold loan, there should the purpose of the loan should be mentioned there. If not, is there any way to check the gold loan, increased gold loans lending for the consumption purpose or the productive?
Good afternoon, sir. So my question is based on, like, in the recent economic survey, they talked about that financial markets can push economic growth up to an extent, and they talked about this inverted U-shaped curve. And India is right now on the increasing trend. So for how long can we hope that India, like, can have growth supported by a financial market?
Last question for today, yes. Even though I know there are several others. Yes.
Good
So-
evening, sir. Thank you for the presentations. So my question is, for the right kind of growth, which is inclusive growth, we need to focus on bringing the poor, the underprivileged into the formal financial institutions. Microfinance institutions have come to exist to facilitate this. And Grameen Banks is one of the most popular innovations in this area. But have we stopped innovating? Have we stopped innovation? Because empirically tested, Grameen banks have not yielded ideal results in all cases. So I'd like to know your views on this.
Please, Mr. Tewari, we start with you.
So I'll start with the gold loan question. So see for a very long time the regulator wanted a purpose for the loan to be tested. Even today also the RBI says that consumption has to be distinguished from productive purposes. I think we need to get beyond this, because clearly how will you keep on checking each particular item? If a person has a medical emergency, for them, though consumption it's most important, and if the bank would not give against gold, they will go to a money lender and take it. So I think we should go beyond this. I don't think it is the remit of a central bank to control the leverage of an individual household level. So I think we should give the benefit of doubt to the householders. They know what they are getting into. Make the loan giving easy. And of course, with the help of CIBIL and other bureaus, we can control the total credit that person has. But if you start to look at purpose for everything, I mean, anyway, we ban lotteries and various other so-called purposes. So I think, in my view, it should be a general purpose. Let us not get into, most of it is anyway business loans. So that is one. I think there was, I've forgotten actually what all the questions were there. Monetary policy, you should answer, Dr. Singh. I don't think we should get into that. You may take that other question.
No, please get into that. Let DSA and DU community benefit from your experience and your views. So I'm here all the time.
I think two RBI people sitting next to me, I would not venture into monetary policy. So, no, but I mean, what was the other question actually? This all got mixed up actually. There was one question on the, I think, the poor, how do they come into the last question? Innovation in the Grameen Bank. Yeah. So I would say, let us not search for perfection in any model. In any economy, it's a messy economy. There are real people and real actions happening all the time. So as long as the end goal is getting achieved, even though little inefficiently, little differently, we should look at that is number one. So let us not seek perfection. Number two is the fact that technology is going to be the real provider of things what we talk about, because without technology, and now today, if a person even at a village, most of the people have phones. It is a different matter that 40% of the overall phones are feature phones, and in the rural areas, about 80%, 90% are feature phones. So how do we create applications for feature phones which are possibly voice-driven and which do the same function as maybe a UPI on a smartphone does? If you are able to accomplish that technologically and it is feasible, then I think the next big leap in the Grameen model or financial inclusion model or whatever else we want to consider, I think that's where we need to go. That's the innovation I think we're looking at.
Just to continue what he was mentioning in terms of financial inclusion, I did not have enough time, but I would leave my slides here. And if you see the one which talked about financial inclusion index, and if you visit the RBI website and you see the papers that are done on financial inclusion, you would find that umpteen parameters have been introduced to ensure that people in the informal sector or those who are out of the formal banking, in what way measurements are being applied for their inclusion. What are the ways we are doing it? The Trends in Banking and Finance report brings out every year, and the latest one is out some time back. It also brings out what innovation is being made, what partnerships are being signed to reach out to bring in more people in the banking architecture. So that part is there. The innovation that you referred to, probably I think you have in mind more of the way we need to ensure how we go out in the areas. So you find that in northeastern areas, several of the interior areas of states like Chhattisgarh, Madhya Pradesh, Jharkhand, parts of Bihar, where you do not have electricity and you do not have internet. What kind of machines we can come in? And the institute that I mentioned, IDRBT, they with the IIT Madras are doing a joint research to come up with ATMs which can function without internet, without electricity, and they can function for 15 to 18 hours, and they can have deposits as well as withdrawals possible. Up to they can store the cash up to 20 lakhs. So this would serve very well the pensioners and others if those machines are taken in. The tests are on, and I'm sure this innovation would be path-breaking not only for India but for the global south in terms of how we ensure that to happen. The idea of gold loan is already answered. On MPC transmission, the point that you mentioned, banking sector can play only a limited role in terms of giving a shape to that idea of transmission. Multiple sort of level of discussions are on at this point to see how we measure inflation. As you know already, food sector and food related debate and discussions have attracted a huge attention of ours in terms of how it goes. The points that essentially were covered by Mr. Tewari in his lecture are valid in terms of responding to your question as to how we go beyond banks, how we see the vibrance of our financial sector that is important for NBFC. When the criticism came in, RBI, which had already increased the weightage for exposure, that has already been reduced, and we are expecting that more liquidity would be available. The note that Professor Singh wrote in the MPC, it would be public very soon, you would find reflection of the dimensions that are there in terms of how we are looking at this transmission gap, if at all it is there. What you also referred to was the larger global debate. You referred to Trump and the transmission. In US, the situation is slightly different. The trouble is, for US, almost 48% of USD is not in US. So their currency is not in their control because of internationalization. And these are the perils of your internationalization of your currency. So that's the price US is paying now. The dollars are outside, inflation is out of control, the productive ability for manufacturing has gone out, and that's what my response would be in terms of the question that you asked about economic survey saying that financial sector cannot be the growth of engine. And this is what, at least for the US, it is so clear that they have to come back to the real sector, the real economy. And this is what I was also mentioning in terms of the new geopolitics. The supply chain or the value chains that are there, their disruptions are a clear indication in terms of how we go forward. I gave example of shipbuilding, and you find that during COVID crisis, after Pulwama and after COVID crisis, China blocked all the shipping containers for us, and we could not import oil because we don't have our own ships, we don't have our own containers, we were dependent on them. And now this situation for last 2 weeks has intensified, and you would see implications of this because US has enhanced tariffs for China. All the container cargo are now stuck, loaded, not going to US. So the cycle that was there of availability of these cargo containers, that is not moving. So that's another crisis which is brewing up. So you find that even if as an economist we leave the question of efficiency on one side and production on the other, you find that this disconnect between the two is emerging. Whether we rank production as our priority as a system, or we lend our support for efficiency. And last 25 years in economics, the whole debate has been on efficiency seeking, restructuring of the economy. So how we bring in change in the production architecture is something which is becoming more and more interesting.
Thank you so much, Professor Chaturvedi, Mr. Tewari. I am certain, and I am being fair in saying that this session has been truly enriching. This session has been unique. It has filled a gap in the discourse, policy discourse at Delhi School of Economics, in that it has highlighted, it has given us deep insights into banking, finance, trade, and very dynamic interconnections among these three areas. Our speakers and chair, they deserve a huge round of applause. Thank you so much. Thank you so much for taking the time out and for giving vibrancy to Delhi School of Economics. With these words, yes, we bring the session to a close. Devesh, you will come to say a few words.
Hello, everyone. This is the time to end this lovely session where we had the two speakers, and they gave a very enlightful and they very the lecture, which gives us a very as the Professor Ram Singh already said that it filled the gap in our curriculum, which was not already discussing a lot about the banking sector, how it is making the India ready for the Viksit Bharat at the rate of 2047. So first and foremost, I really want to thank Mr. Ashwini K. Tewari, the Managing Director, State Bank of India, for his enlightful and very the interesting lecture on how the state bank have evolved and is really, really helping the Indian economy to reach the level of the Viksit Bharat at the rate 2047. And then we are deeply thankful for Professor Sachin Chaturvedi, Director General of RIS, for graciously chairing today's session. Your presence and observation enriched the discourse and added the immense value to the session. Thank you so much. Special thanks to our Director of Delhi School of Economics for giving us this opportunity to be a part of this lecture, this very enriched lecture here. And I would also like to thank DSE office staff and the CD staff to effectively coordinate and organize this event. And last but not least, I really want to thank the audience, which comprises the colleagues from DSE, the colleagues from the various college of DU, and research scholar from DSE, and my dear students. So without them, it won't be really a successful event. So I really want to thank everyone, and thank you so much.
Thank you very much, sir. With this, we conclude today's session. Everyone present is invited to proceed for tea in the front lawns. Students in the audience are requested to exit only once the guests and faculty have departed. Thank you everyone for joining this session.